Disclaimer. November 26, 2019, 9:17 p.m. Greenwich Mean Time. A transaction flashed through the Brussels-based financial messaging system, SWIFT. Code, CNY. Not USD. $134.5 million. For Iranian oil. The payment bypassed the New York Federal Reserve. It bypassed the U.S. Treasury. For the first time in modern history, a sanctioned nation conducted a major commodity trade without touching the U.S. dollar. A single, silent transaction. And the foundation of the global financial system cracked. 1521. Spain claims the New World. 1637. Holland's tulip mania peaks. 1925. Britain returns to the gold standard. 2024. The U.S. debt breaches $34 trillion. For empires. For global reserve currencies. One pattern. Thesis statement ***. This is not a story of coincidence. This is the story of a financial death cycle. A predictable, 90-year pattern of imperial monetary dominance and collapse. History shows that no global reserve currency survives a century. Not one. They rise. They rule the world. They become unquestioned, inevitable, permanent. Then, they break. The pattern is not random. It is a 5-stage autopsy of economic hegemony. And the U.S. dollar, the backbone of every market, every trade, every central bank reserve for 80 years, is deep inside this cycle. You were never taught this timeline, but you cannot escape its consequences. The framework, the 5 stages of monetary collapse ***. Every dominant currency follows the same path, the same 5 stages. Stage 1. The anchor, a new, credible asset backs the currency, creating global trust. Stage 2. The domination. The currency becomes the world's essential tool for trade and reserves. Stage 3. The entitlement. The issuing empire abuses its privilege, exporting inflation and debt. Stage 4. The trust deficit. Key allies and rivals begin to openly rebel, building escape routes. Stage 5. The relinquishment. A new anchor emerges. The old currency is abandoned. Spain's silver real. The Dutch guilder. The British pound sterling. Each completed the cycle in roughly 80 to 100 years. From anchor to oblivion. And the U.S. dollar? It passed stage 3 in 1971. It entered stage 4 in 2022. We are witnessing the trust deficit in real time. The 90-year pattern is clear. The clock is ticking. The rise, from anchor to empire ***. Every global currency begins with a simple promise. A rock-solid anchor that convinces the world to trust a piece of paper or a disk of metal from a foreign power. For Spain, it was silver. 1521. Conquest of the Aztec Empire. 1545. Discovery of the Potosi Silver Mountain, modern Bolivia. By 1600, Spanish-controlled mines produced over 150,000 tons of silver. The Spanish real, backed by this flood of tangible wealth, became the world's first truly global currency. For the Dutch, it was disciplined finance and trade. 1609. The Bank of Amsterdam is founded, guaranteeing guilder deposits. It pioneered modern fractional reserve banking with a public trust model. By 1670, the Dutch guilder was the preferred currency for European trade, viewed as good as gold. For Britain, it was the formal gold standard. 1821. Britain officially adopts the gold standard, making pounds sterling convertible to a fixed weight of gold. 1850 to 1914. The Pax Britannica. The pound is the undisputed currency of global commerce, finance, and central bank reserves. And for America, it was a combination of catastrophic war and exhausted rivals. 1914 to 1945. 2 world wars devastate European economies. America becomes the arsenal and creditor. July 1944, Bretton Woods, New Hampshire. 44 allied nations sign the agreement. The world's new financial architecture is drafted. The U.S. dollar is officially anointed as the world's reserve currency, anchored to gold at $35 per ounce. All other currencies pegged to the dollar. America holds over 60% of the world's official gold reserves. The promise was absolute. The anchor, unbreakable. By 1960, the US dollar comprised over 70% of global foreign exchange reserves. The dollar was the global economy. It seemed permanent. The fatal decision, breaking the anchor ***. Invincibility breeds arrogance. The fatal decision is always the same. To break the very anchor that created trust, believing the world has no choice but to accept a hollow promise. For Spain, it was the relentless debasement of its silver coins. 1640. Facing endless wars, Spain begins cutting the silver content in its reals. The world noticed. Trust evaporated. Gresham's law took hold. Bad money drives out good. For Britain, it was the suspension and then mismanagement of gold convertibility. 1914. Britain abandons the gold standard to fund World War I. 1925. It returns at the pre-war parity, overvaluing the pound and crushing its exports, a decision Keynes called an act of collective madness. 1931. Forced to abandon gold again, permanently damaging its credibility as the anchor of the global system. For America, the date is precise. August 15, 1971. 9 p.m. Eastern Standard Time. President Richard Nixon addresses the nation. He announces the temporary suspension of the U.S. dollar's convertibility into gold. The Bretton Woods anchor is severed. The dollar is now backed by nothing but the full faith and credit of the United States government. A system of pure fiat faith begins. They called it the Nixon shock. The fatal decision was made. The world was told to trust the management of the U.S. Federal Reserve, not the constraint of a physical anchor. The entitlement stage had begun, and the 90-year clock started ticking louder. Nobody saw the full consequence that night, but the pattern was now in motion. The pattern breakdown ***. Stage 1. The anchor, the foundation of trust. Every dominant currency needs a bedrock. Not just wealth, but a credible, often physical, constraint that forces monetary discipline. It is the promise that creates the global franchise. Historical example 1. Spain, circa 1520 to 1600. The anchor * silver from the New World. The Spanish real was not just a coin. It was a portable, standardized unit of actual, mined wealth. The discipline * the Casa de la Moneda, the mint, enforced a rigid silver standard. For decades, the weight and purity were sacrosanct. Global trust * by 1600, the Spanish real was the dollar of its day, used from the markets of Manila to the ports of Antwerp. It was the world's first universal currency because its value was in your hand. Historical example 2. Britain, 1821 to 1914. The anchor * the Gold Standard Act of 1821. The British government legally guaranteed to redeem any pound sterling for a fixed quantity of gold. The discipline * the Bank of England's reserves had to back its note issuance. This limited its ability to print money, creating long-term price stability. Global trust *, as safe as the Bank of England, became a global proverb. The pound was considered good as gold, making it the logical vehicle for 60% of world trade by 1914. Historical example 3. United States, 1944 to 1971. The anchor * the Bretton Woods Agreement. The U.S. dollar was pegged to gold at $35 per ounce. All other currencies were pegged to the dollar. The discipline * the U.S. had to maintain sufficient gold reserves to back foreign dollar holdings. This acted as a check on domestic inflation and excessive spending. Global trust * by 1950, the U.S. held $574 billion in gold reserves, adjusted for inflation, over 60% of the world's total. The dollar became synonymous with post-war reconstruction and stability. The pattern is absolute. No trust without a credible anchor. No hegemony without trust. Stage 2. Domination. The world's essential tool ***. The anchor creates trust. Domination cements it. The currency becomes the indispensable plumbing of the global system, for trade, for commodities, for debt, for reserves. Historical example 1. Spain, circa 1550 to 1620. The tool * the Spanish Peace of 8, Real de Ocho, became the standard for intercontinental trade. The reach asterisk it financed the Spanish Empire in Europe, bought spices in Asia, and slaves in Africa. It was legal tender in the American colonies until the 1850s. The statistic asterisk at its peak, Spanish silver accounted for over 80% of the world's coined silver. The global economy ran on it. Historical example 2, Britain, 1850 to 1914. The tool asterisk the pound sterling as the currency of invoice. Global commodities, wheat, cotton, coal, were priced and traded in pounds. The reach asterisk the City of London became the world's banker. Foreign governments and corporations issued bonds in sterling. The statistic asterisk on the eve of World War I. Nearly 90% of global trade finance was conducted in British pounds. Central banks held sterling as their primary reserve. Historical example 3, United States, 1950 to 2000. The tool asterisk the petrodollar system. After the 1973 oil crisis, the U.S. struck a deal with Saudi Arabia. Oil would be sold only in U.S. dollars. In return, the U.S. provided military protection. The reach asterisk every nation needing oil needed dollars first. This created a perpetual, structural global demand for the currency. The statistic asterisk by 2001, the U.S. dollar constituted over 72% of identified central bank foreign exchange reserves. The global dollar-based financial system was complete. Domination is the peak. It feels eternal. It creates the illusion that the world needs the currency more than the issuer needs discipline. Stage 3. Entitlement. The abuse of privilege asterisk asterisk. This is the turning point. The empire mistakes dominance for invincibility. It begins to export its inflation and finance its excesses by exploiting the global demand for its currency. The anchor is forgotten or deliberately broken. Historical example 1. Spain, circa 1620 to 1640. The abuse asterisk the price revolution. Flooding Europe with silver caused massive inflation in Spain itself. Instead of reforming, the crown debased the coinage to fund endless wars against the Dutch and English. The data asterisk between 1590 to 1640, prices in Spain rose approximately 400%. The value of the real collapsed in international markets. The quote asterisk contemporary economist Martín González de Celarigo wrote, "The more money we have, the poorer we become." The system was eating itself. Historical example 2, Britain, 1914 to 1931. The abuse asterisk financing World War I by printing money and suspending gold convertibility. After the war, it attempted to return to the pre-war parity, overvaluing the pound to restore prestige. The data asterisk UK war debt soared from £650 million in 1914 to £7.4 billion in 1919. The overvalued pound devastated British industry. Unemployment exceeded 20%. The consequence asterisk the failed return to gold in 1925 led directly to the general strike of 1926 and forced Britain off gold permanently in 1931. Global faith was shattered. Historical example 3, United States, 1971 present. The abuse asterisk the exorbitant privilege. After Nixon severed the gold anchor, the U.S. could now finance trade deficits and government spending by printing the world's reserve currency. The data asterisk U.S. total public debt, $398 billion in 1970, $34 trillion in 2024. The U.S. runs perpetual current account deficits, exporting dollars and inflation to the world. The consequence asterisk the Nixon shock was not temporary. It became the system. The discipline of the anchor was replaced by the full faith and credit of a debt machine. Entitlement is the cancer. It is the belief that rules apply to others, but not to the issuer of the world's money. Stage 4. The trust deficit, the silent rebellion asterisk asterisk. The world is not stupid. Trading partners and rivals see the inflation being exported. They see the debt accumulating. They begin to hedge. Quietly at first, then openly. They build systems to escape the dependency. Historical example 1. Spain, circa 1640 to 1700. The rebellion *, the Dutch, fighting for independence, created a superior financial system, the Amsterdam Stock Exchange, and the guilder. Merchants across Europe began preferring Dutch bank deposits over volatile Spanish silver. The data * capital flight from Spain became endemic. The Spanish crown declared multiple bankruptcies in 1607, 1627, 1647, and 1653, destroying trust. The indicator * the rise of Amsterdam as Europe's new financial center. The anchor was shifting from Spanish silver to Dutch credit. Historical example 2, Britain, 1931 to 1944. The rebellion *, the 1931 abandonment of gold triggered a sterling area, but the true threat was the rising US dollar. The Lend-Lease Act of 1941 made Britain a financial vassal to America. The data: UK gold and dollar reserves fell from £605 million in 1938 to just £3 million by 1941. Britain was bankrupt. The indicator: the 1944 Bretton Woods Conference. Britain's delegate, John Maynard Keynes, proposed a global currency bancor to avoid dollar dominance. He lost. The baton was forcibly passed. Historical example 3, United States, 2022 present. The rebellion, de-dollarization initiatives. Not from fringe states, but from major economies. The data: BRICS expansion, 2023 to 2024. The bloc, openly discussing an alternative currency, grew to include oil giants Saudi Arabia, UAE, and Iran. Central bank gold buying, 2022 to 2023 record purchases of 1,136 tons per year. A clear hedge against dollar-based financial systems. Bilateral trade pacts. China-Russia trade settled in yuan/rubles exceeds 90%. India-UAE oil trade in rupees. Brazil-Argentina discussing a common currency. The indicator: November 2022. The U.S. froze $300 billion in Russian central bank assets. For every finance minister worldwide, it was a stark lesson. Dollar reserves are not your assets. They are political liabilities. The trust deficit is not a loud crash. It is the silent, strategic diversification away from a core holding. It is the smell of smoke in a crowded theater. 1500 hours, Stage 5. Relinquishment, the new anchor. The end is not a sudden death. It is a gradual, then sudden, shift to a new anchor that offers the discipline and neutrality the old hegemon abandoned. The old currency doesn't vanish, it becomes ordinary. Historical example 1, Spain to Holland, 1648 to 1720. The new anchor, the Bank of Amsterdam's guarantee and the depth of Dutch capital markets. The transition: the 1648 Peace of Westphalia recognized Dutch independence. Over the next 70 years, Amsterdam replaced Seville as the nexus of global finance. The final act: the 1720 collapse of the British South Sea bubble and French Mississippi scheme saw capital flee to Dutch guilders. The torch was passed. Historical example 2, Britain to United States, 1944 to 1971. The new anchor: U.S. gold reserves and industrial might, formalized at Bretton Woods. The transition: the 1956 Suez Crisis proved Britain could not act without U.S. financial approval. The pound was devalued in 1967. The final act: August 15, 1971. Nixon closed the gold window. The sterling area dissolved. The dollar was supreme. The pound became a regional currency. Historical example 3, the pattern's endpoint. History does not repeat, but it rhymes. The relinquishment stage requires a credible, alternative structure. The candidate is not a single currency, but a basket or a system. The potential anchors: central bank digital currencies, CBDCs, with new settlement layers, a commodity basket, gold plus critical minerals, or a digital gold standard. The final act: projection, not the disappearance of the dollar, but its demotion. From the sole reserve asset to a primary one among peers. Its exorbitant privilege, revoked. The 90-year pattern is complete. Anchor: domination. Entitlement: trust deficit. Relinquishment: 5 acts in a play that has run for 5 centuries. 1630, Chapter 4. We are here now. We are in Stage 4, the trust deficit. The historical autopsy is complete. The pattern is irrefutable, and the United States dollar is not an exception to history. It is a subject of it. The evidence is no longer anecdotal. It is quantitative, geopolitical, and accelerating. Current evidence, the data of defection. Reserve currency erosion *. The U.S. dollar share of global central bank reserves has fallen from 72% in 2001 to 58% in 2024, IMF COFR data. This 14-point drop is the largest sustained decline in the dollar's hegemony since Bretton Woods. Treasury weaponization fallout * since the 2022 Russian asset freeze. The share of U.S. treasuries held by foreign official entities, central banks, governments, has plummeted from 34% in 2013 to under 23% in 2024. They are not buying. They are discreetly exiting. Commodity pricing rebellion * for decades, the rule was absolute. Oil in dollars. In 2023, over 20% of Russian oil exports were priced in yuan. China began settling LNG trades in yuan with France's TotalEnergies. The petrodollar monopoly has a visible crack. The bilateral escape hatches * the number of bilateral currency swap lines not involving the U.S. dollar has exploded. The People's Bank of China has established over 40 swap lines totaling $500 billion. These are emergency pipes for a non-dollar financial system, built in plain sight. The catalyst, March 2022 *. Every stage needs a trigger. A point of no return that shifts the pattern from slow decay to conscious flight. For the dollar's trust deficit, the date is precise. February 26, 2022. 5:00 p.m. GMT, ***. The US, EU, UK, and Canada issue a joint statement. We will ensure that selected Russian banks are removed from the SWIFT messaging system. Days later, the $300 billion freeze of Russian central bank assets is announced. The intended message, we will punish aggression. The received message in every finance ministry from Riyadh to Beijing. ***, the infrastructure of the dollar is a weapon. Your reserves are not sovereign if they are in our system. ***. This was not 1971's economic decision, Nixon. This was a geopolitical decision with profound financial consequences. It answered the question, what are the risks of holding dollars? With brutal clarity. It accelerated the trust deficit from a decades-long process into a strategic imperative for a significant part of the world. Every treasury official on planet Earth began running a new calculation. How do we conduct essential trade if we are on the wrong side of a future sanction? Stage 4 indicators. The dashboard of decline ***. This is not theory. These are the real-time metrics of a system in the trust deficit phase. De-dollarization of trade ***. China's cross-border transactions settled in yuan surpassed 50% for the first time in 2023. In 2010, that figure was near 0%. Gold migration * central banks in the global East are buying gold at record rates not seen since Bretton Woods collapsed. China's reported reserves have increased by over 300 tons in the last 18 months, and that's just the official reported figure. U.S. Fiscal credibility ***. The U.S. debt-to-GDP ratio crossed 120% in 2024. The Congressional Budget Office projects it will hit 130% within 5 years. This is the entitlement fueling the trust deficit. Institutional rhetoric ***. In April 2023, the president of the BRICS New Development Bank stated, "We need a transactional currency that is not the dollar." This is no longer fringe talk. It is institutional planning. Dollar's FX share, while still dominant, the dollar's share of daily foreign exchange transactions, FX turnover, has stagnated around 88%. The growth is in other currencies, a category that has doubled its share since 2010. Treasury market stress. The world's risk-free asset is showing structural cracks. The 2019 and 2020 repo market crises and the ongoing illiquidity concerns signal that the sheer scale of U.S. debt is overwhelming its own market infrastructure. Alternative settlement systems. China's CIPS, cross-border interbank payment system, now has over 140 direct participants, handling over $12 trillion per year. While still a fraction of SWIFT's volume, its growth trajectory is vertical. Strategic stockpiling. Nations are stockpiling critical commodities, food, energy, minerals, directly, moving away from a pure just-in-time, pay-in-dollars model towards sovereign security. This reduces dollar-denominated trade flows. The pattern is not a prediction. It is a checklist, and the boxes are being ticked, one by one, quarter by quarter. We are not approaching stage 4. We are in it. Consequences and timeline ***. What this means: winners, losers, and a new reality. The relinquishment of dollar hegemony will not be an orderly seminar. It will be a violent repricing of every global asset, a redrawing of geopolitical power maps, and a transfer of wealth on a scale not seen since 1945. History is clear on who gets crushed and who emerges from the chaos. For the losers ***, the U.S. consumer and Treasury ***, the end of the exorbitant privilege means the U.S. can no longer finance its standard of living and fiscal deficits with cheap, endless foreign capital. Interest rates will structurally rise. Inflation will become a persistent, not transitory, threat. The cost of everything imported will soar. Dollar-denominated asset holders * U.S. Treasury bonds, long considered the risk-free asset, will be re-rated as the currency risk escalates. A sustained, volatile downrate cycle is inevitable. Equities reliant on cheap dollar financing and global consumption will face a multi-year compression. Traditional financial hubs * New York and London's dominance as financial centers is tied to dollar clearing. As trade and finance fragment into regional blocks, a euro/yuan zone, a Gulf currency bloc, their relative power diminishes. The financial map multipolarizes. Countries with high dollar-denominated debt * emerging markets that borrowed heavily in dollars will face a double crisis: a stronger local currency debt burden and potentially scarce dollar liquidity. It is the 1997 Asian financial crisis pattern on a wider scale. For the winners **, commodity sovereigns with clean balance sheets * nations with critical natural resources, energy, metals, food, and low debt. Think parts of the Gulf, Brazil, Canada, Australia, will gain immense strategic leverage. Their commodities are the new anchor. Gold and strategic asset custodians **, the physical gold market and the institutions that store, transport, and ensure it become the new critical infrastructure. Jurisdictions with strong property rights and neutrality, Switzerland, Singapore, win. The architects of new systems * the entities that successfully launch and govern the new transactional platforms, whether a digital SDR, a gold-backed token, or a dominant CBDC network, will capture the seigniorage of the next cycle. This is the 21st century equivalent of winning the Bretton Woods Conference. Domestic-focused, productive economies * nations with strong internal markets, manufacturing self-sufficiency, and energy independence will be insulated from the worst of the currency volatility. They will trade on bilateral terms, not dollar terms. History's lesson is brutal. The winner of the last cycle is almost never the winner of the next. Spain did not become Holland. Britain did not remain America. The U.S. will not control the system that succeeds the dollar. Projected timeline: the 25-year transition **. Based on the historical compression of timelines, Spain's decline took 80 years, Britain's 40, and the accelerated pace of digital technology. Here is the likely progression. Phase A: the fragmentation, 2025 to 2035. The messy middle. No single currency replaces the dollar. Instead, a tripartite or multipolar system emerges. A digital yuan bloc in Asia/Africa, a Eurocentric bloc, and a diminished but still significant dollar zone in the Americas. Currency volatility becomes the norm. Persistent 10 to 20% annual swings in major forex pairs devastate unprepared corporations and investors. Central banks complete their strategic gold accumulation. Official reserves data becomes increasingly opaque, a sign of active preparation. Key event asterisk a major commodity, likely oil, is conclusively priced and settled in a non-dollar currency by a G20 nation, with others following within 18 months. Phase B, the crisis and new anchor, 2030 to 2040. A sovereign liquidity crisis triggers the final shift. A large, dollar-dependent nation or a major Western financial institution faces a funding crisis that the Fed cannot or will not solve with swap lines. The dollar safety net is revealed to be full of holes. A new, technology-enabled anchor gains critical consensus. This could be a IMF special drawing right, SDR, basket with a digital settlement layer, a BIS-coordinated CBDC network, or a privately evolved digital asset backed by a basket of commodities and sovereign debt. Key event asterisk a coalition of nations, e.g., BRICS Plus, formally proposes and begins testing a new unit of account for cross-border trade, bypassing bilateral swap lines. Phase C, the relinquishment and reset, 2040 to 2050. The dollar is demoted. It becomes a primary reserve currency, not the reserve currency. Its share of global reserves stabilizes between 30 to 40%, akin to the euro today. The U.S. undergoes a brutal, but necessary, fiscal restructuring. Without the global subsidy, it is forced to balance its books, revive domestic industry, and renegotiate its social contract. A new financial architecture is codified, likely through a Bretton Woods 3.0 conference from which the U.S. does not emerge as the undisputed chair. The 90-year cycle concludes. A new hegemon or hegemonic system is in place, beginning its own stage 1, the anchor. The pattern is clear. It is mathematical. It is behavioral. It has repeated across centuries, continents, and empires. This is not a conspiracy. It is a cycle of trust earned, exploited, and broken. The question for you is no longer if the dollar will relinquish its singular hegemony. The historical evidence renders that outcome a statistical certainty. The only questions are, how fast will the final stages unfold? Are you positioned in the assets and geographies that will benefit from the transition rather than be destroyed by it? And when the next anchor is being forged in secret meetings and digital labs, will you be watching the old world fade or preparing for the new one? The 90-year pattern gives you the timeline. History gives you the map. Your move. This documentary from Money Meltdown is for educational and informational purposes only. The analysis presented is based on historical patterns, publicly available economic data, and the interpretations of economic historians. It presents a theoretical framework for understanding long-term monetary cycles. This video is not financial advice. It is not a recommendation to buy, sell, or hold any specific asset, currency, or security. It is not political advice. The references to nations, governments, and policies are for historical and economic context only. All projections concerning future timelines and events are speculative, based on historical precedent, and are not claims of certainty. The future is not predetermined, and countless variables can alter the course of history. The comparisons between modern nations and historical empires are analytical models, not direct equivalencies. Viewers are strongly encouraged to conduct their own research, consult with qualified financial and political experts, and draw their own informed conclusions. Economy Rewind aims to illuminate patterns, not predict the future. Thank you for watching.